In the first quarter of 2024, inflation continued its downward trajectory. Annual growth of 3.6% was half a percentage point lower than at the end of last year. So were our concerns about sticky inflation unfounded? Well, like most things in economics, the devil is in the detail. Firstly, underlying inflation, so the RBA's preferred measure that strips out volatile elements and other short-term effects, has been higher than headline inflation for 2 consecutive quarters and saw a smaller decline as well. Trimmed mean inflation sits at about 4%. Secondly, while goods inflation teeters on the edge of the RBA's target band, services inflation has remained high and is moderating only gradually. Services inflation of 4% has been a key contributor to higher underlying inflation. Thirdly, we've just seen a federal budget handed down that will inject an additional $10 billion into the economy in FY25. This is on top of $24 billion that households will receive from the Stage 3 tax cuts, which will take effect from July. So what does all this mean for the RBA? Well, currently financial markets expect the next cash rate movement to be downward, with a decline fully priced in towards the end of 2025. This timeline has been pushed out by about 6 months since our last update. Things are suddenly looking pretty sticky again. So the key determinant of our inflation, and therefore our cash rate pathway, it's going to be households. Protecting the increasingly vulnerable looking household sector, which has seen real disposable incomes fall at 10% on a per person basis, has been the limiting factor on further rate rises to date. Last month's tepid consumer sentiment and retail data gives more pause for thought. So with the sources of lingering inflation increasingly coming from costs such as energy and insurance and not household demand, continued rate rises could prove less efficacious. So what other options are at our disposal to combat inflation? Well, the scene was set for fiscal policy to step in. Compared to the relatively blunt cash rate, we have a broad range of fiscal instruments which can provide nuanced, targeted impacts across the economy. And of course, this year's key fiscal announcements came from Parliament House last month in the form of the federal budget. Before budget night, Treasurer Chalmers stated the target explicitly himself. The government would support the RBA's objectives and not exacerbate inflationary pressures. On reflection, it's difficult to say the budget unambiguously achieved this goal. Now, there were lots of positives. Cost of living measures, alongside the energy transition, was at the forefront of the budget, which is great. Providing energy bill relief to households and businesses, increasing rent support payments, reducing the cost of medicines, and much needed wage increases for care economy workers. In and of themselves, appropriate measures to help households feeling the weight of 3 years of high inflation. The challenge is, at a macro level, government policy decisions will inject an additional $24 billion into the economy, of which about $10 billion will occur next financial year. Combine this with the Stage 3 tax cuts, and we have a stimulus equivalent to about 1.5% of GDP, while the RBA's fight against inflation reaches a crescendo. So what does the inflation outlook mean for businesses? Well, on the revenue side, Australian businesses will benefit from cost of living measures to the extent they translate into higher consumer spending. To unlock value on the cost side, businesses will have to look beyond increasingly high-cost areas such as energy and construction for productivity-enhancing investments. In AI, for example, PwC's AI Jobs Barometer found sectors more exposed to AI are experiencing around 5 times the labour productivity growth of non-AI sectors. At a macro level, Australian businesses just need to invest more. Business investment is equivalent to around 24% of GDP currently. So this is up from the record low of 20% during COVID, but remains below the long-term average of 27%. The latest data shows real capital expenditure grew 5.5% in the year to March. Underlying data reveal the energy transition and investments in future-proofing industries such as data centres underpin an increasing pipeline of work. So generating sustained material growth and investment will require businesses to leverage capital opportunities to help fund future growth. With the right expertise and the right kind of capital, many businesses are capable of growing in both size and profitability to create value for business owners, employees, and throughout the wider Australian economy.